Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
Alright folks, you're on the Property Couch. I'm Bryce Holdaway, co-host of Location Australia on Foxtel's The Lifestyle channel, and he's Ben Kingsley, the chair of the Property Investment Professionals of Australia and the current Property Investment Advisor of the Year. And we're bringing you the insider's guide to property investing. How you going, Ben?
Good, mate. Yeah, I'm up and about this morning.
How are you?
Yeah, even though the Pies lost. It's been a good week. Back slowly getting better and better, so up and about.
I noticed you didn't tip your old team there, so you're just a fair weather supporter?
No, not a fair weather supporter. I'm sensible, mate. You know, like I just thought that Port would get up with obviously the sad news of Phil Walsh and being someone who'd been at the Port club through the premiership year and then also back again. So it was logical for me. Adelaide Oval, 45,000 screaming Port fans. I thought it was going to be a hard job, and I was proven right.
Mate, I was disappointed to see that you had tipped. I thought you were going to be a one-eye Collingwood supporter and tip them because Sinners I'm only two ahead of you, and I forgot to put my tips in last week, so you got one back on me. So not happy. But let's talk about property investing, the thing we talk about every week.
Yep.
Last week we talked about buyers agents and what they are and how you can use them in the marketplace,
Yep.
and we kind of concluded in saying let's talk about the four ways that a property investor will pay. And one of the reasons I want to talk about this is because, as of the listeners know, each week I'm a buyer's agent in the field. I'm often talking to people who want to use a buyer's agent, and quite often I talk about this regularly because I'm up against, as a buyer's agent, I'm up against the other side of the industry that do things for, inverted commas, for free, and they at face value appear to be cheaper than I do. But it's not until we unpack these four things it really gives it a bit more balance. So for the benefit of the listeners, the four ways that a property investor will pay, in our view, having done this for many, many years and seeing hundreds and hundreds of examples of people buying property, is this. Number one, they buy the wrong asset. Number two, they'll procrastinate. Number three, they'll pay too much. And number four, professional advice. And I always just say to people, it's up to you. It's your choice. You're going to pay in one of those four ways, and what is it?
Yeah, I like the way you frame this one, Bryce. It's about sort of saying when we're talking about paying, well, paying in procrastination sense is about missing out or losing the return on investment and the wealth creation opportunity. But we'll start with the top. Let's talk about buying the wrong asset, and obviously this is. I do a lot of research in the business, and when we're giving advice to clients. When I'm doing property investment plans, I'm trying to understand their cash flow needs, and then I'm also making recommendations around purchase price and around return on investment. And return on investment in the property sense is capital growth and rental yield. So when I talk about buying the wrong asset, and what we're trying to tell the listeners today is there's going to be some blood on the streets in probably 2 to 3 years where there's an absolute boom of medium and high density apartments that are being built at the moment. And I suspect, as what occurred throughout the Docklands area with an oversupply, and also in Sydney and Melbourne during that 2001 to 2003 period, there were a lot of people who lost a lot of money when those properties eventually came online. So once they were built, because you're buying them off the plan at the moment, and so once they're built and they get their certificate of occupancy, we've got to send the valuer in there. And some of these properties back, I remember, they were sort of selling for early fives, 2-bedroom apartments, and they were valuing up at around 410, 415. So that's the art of understanding, and that's an easy win. I mean, if the listeners just take away that if you're talking about the fundamentals of return on investment, you're talking about supply and demand. Now, the only marketplace in property that can turn the tap on in supply is high density units. Very hard to turn big supply on in terms of house and land packages or in existing areas especially. So anything that's new, where there's a Lego land being built, in other words, even some stuff that's 5, 10, 15 kilometres from town, and they've been identified where they've knocked down the old factories and they're starting to build townhouses and they're what I call Lego land, where it's the same homogenous style of apartment. And even though it looks good in terms of the marketing collateral, there's 40 or 50 or 60 of the same asset. And they're the ones that underperform because there's no character or uniqueness about them. And so when the buyer comes in, and remember, it's the owner-occupier that drives true value, they just don't perform. So there's a couple of bits of gold in there around sort of saying, well, how do I limit or reduce my risk of that? And that is looking at areas that the land's been fully utilised, and then looking at the asset class that's in real demand, i.e. 3 and 4 bedroom houses closer to the city, where town planning regulations allow for less of that stock to be built. So I was thinking the other day, it's about the Mona Lisa. If the Mona Lisa came up for sale in the Louvre, could you imagine what it would sell for? I mean, it's priceless.
I couldn't imagine anyone would have enough cash.
Now, in reality, is there a real sense of what the reality of that picture's worth, or that painting, I should say? It's not a picture. That painting's worth, and unfortunately, when people are looking each weekend and they've got their brief is a 4-bedroom house, but they want to be within 5 kilometres of the city. Well, unfortunately, there's only a limited amount of supply there. So everyone sort of says there's a bubble or something's going to be happening. It's like, no, there's not, because these people can afford it, because they wouldn't be bidding if they couldn't. And can they afford it in that sense? So we don't see big corrections in those things. We definitely see it in the elite space, in the 5 million to 10 million space. When times are tough, people give up a bit of coin. But in terms of your baseline, run-of-the-mill, good quality asset in a great location, those things are pretty handy.
Yeah, no, good point. The wrong asset is a big one, I think, because particularly if we've used Sydney as an example quite often in this podcast, but if you think about people who get caught up in the FOMO or caught up with keeping up with the Joneses, they're not really applying too much science other than they need a property. But there's, the other day I was looking at a property that I wanted to buy for a client, and as soon as I got to the pool, I saw there was a pool. For me, it was like, it's in Queensland. There's an expectation that you'd have a pool, but for these people who are interstate investors who were never thinking about using the property, it's actually just bad news as an investment. Because I said to Chrissy, who I was chatting with, I said, look, there's a pool. There must be a minimum of 30 townhouses in that complex, and there was in fact 39. And you just know these things from experience, that for a developer to put a pool in, they know that they've got to absorb these costs amongst a number of people, and to make it work in terms of economies of scale needs to be big. And what you talked about in terms of Legoland, people in Australia value privacy, they value space, and they still value a bit of individuality, even though we've talked about our cities will grow and get more dense over time. That's still the case as probably into the next cycle. And I think that's really important about picking the right asset. So I always say, we've got a good friend, Damien Collins, who always says that if you're looking at the brand new market for apartments, for example, and you've researched the entire market, you're probably knowing about 3% of the stock that's on there, because brand new represents such a small portion of the market. So
Damien's a good operator there at Momentum Wealth. He does a great job over in Western Australia. He's got an excellent outfit, and again, they understand the value of great asset selection.
Absolutely. So I think that's probably the number one thing that we see people getting wrong, and that's just not a theory. You more than me, but I see a lot of portfolios where someone just bears their soul. They say, this is exactly what I've got. And and I always find it really interesting when someone looks at a property performance. So we could be looking at something where they bought it maybe 5 or 6 years ago, and they never ever bring up the negativity towards the advisor that puts them into the property. They always say, oh, geez, that one just didn't perform. And it's never really part of the post-mortem to say, maybe I took the wrong advice from the person who suggested I should buy that one, rather than sort of just, hey, that one didn't perform, hope I get it right the next time.
And they're good. I mean, when I'm looking at the marketing collateral and all the images show, the people around the pool, and, so even the owner-occupied buyer has there's a gymnasium, there's a tennis court, and there's a pool. And you'd think as an investor that, well, wait a minute, tenants would want that, wouldn't they? And the reality is, yes, some tenants would. I think these assets do attract a reasonable tenant pool, but unfortunately, because of the holding costs and the actual cost of maintaining all of these extra resources. I mean, just to give you an idea, a lift, if you want to change a lift over in 25 years, you're talking at least $250,000 to $500,000 depending on how many levels you're going up. Well, who has to fund that? Well, special levies have to fund those types of things. So from a return on investment, you're looking to have the holding cost as low as possible to get the maximum return. So in reality, I'm seduced by the bling again, which is a sort of common theme on how they sell the new stuff. But I could have got a better return from that 4-pack unit block around the corner that's got just the same amenity around the area, and I could befriend someone in there to have a swim. I'll probably walk in there and have a swim anyway. But whatever it may be, and it's just not going to deliver the return.
I always talk about my first investment property. There was a pool, there was a caretaker, and a lift involved. So my body corporates were enormous. And the worst part about that was I don't have this asset anymore, but the worst part about it was the lift was in the middle tower and I was on a side tower. So my tenants didn't even get the benefit of using the lift, even though I had to pay for my share of it in the body corporate. So that was obviously a bad mistake. I had a property that I was at the 11th hour of buying this week for a client. And I had all the disclosures. It was in Queensland. It was in Brisbane. Had all the disclosure statements sent to me. Had a healthy sinking fund of about $16,000. Body corporate looked reasonable. The asset stacked up. I back tested its historical performance. The rent actually had a tenant in place, so I could actually confirm the yield. So the combination that I was looking for the client was great. Investment grade suburb. So everything was looking really good.
Yep.
And I was just about to make an offer, and I said to the agent, look, you don't have the body corporate minutes in the disclosure document. I need to actually have a look. And she said, why don't you make it subject to satisfactory body corporate records? And I said, look, I could do that, but why don't you just quickly get the owner to get a copy of the minutes on their iPhone, send me a copy, and I'll have a quick look. And that was actually a really good move, and it's probably a good lesson for the listeners.
Great tip for listeners.
Because it was actually a house at the front, then had subdivided in the past and built 4 one-bedroom apartments at the back. Nothing wrong with that at this stage.
Yep.
Street was good, street appeal was good. But once we looked under the bonnet, there was actually the way that he'd done the strata was that he had 4 votes, the guy at the front, and then the 4 at the back had 1 vote each.
So controlling interest.
He had balance of power.
Yep.
And so how did this play out? We actually had $16,000 in the sinking fund. And when I looked through the minutes, Motion 10 talked about the fact that he wanted the retaining wall at the back of his property to be fixed. And that obviously comes as part of a body corporate. And therefore, he'd seen that there was $16,000 in the fund, and this is a way for the people at the back to actually fund the retaining wall. And they were, and once I unpacked it a little bit, the owner was probably selling because they were going to dispute resolution to try and get this resolved because they didn't want the retaining wall done, but they didn't have enough. Even if all 4 people at the back had voted against it, he still was just at a stalemate.
Yeah.
And effectively,
so mediation.
That just goes to show that property investing is a process, not an event.
Yeah.
We talk about this all the time. You said it during the week when I wrote an article, which is going to appear as the cover story for the Money magazine in a couple of months' time. We'll tell our listeners about that when that comes closer.
Yep.
And you said and you made a comment when you reviewed it for me. It's just complete madness for anyone to think that they can buy a property after 1 weekend of looking at real estate.
Yeah, they do. I mean, or they get, they're time poor professionals or people who have got the capacity to invest. And the other one that really grates me is the in-house 3 hours education. And then all of a sudden I'm signed up to some membership program for life, which, is the life of the business that runs. I mean, let's face it, some of these businesses close down and then they rebadge and reopen in another sense. So that's the scary part. I mean, if you think, I always use the common sense rule, and that is, I would say to anyone who's talking to an advisor or spruiker, if they can't answer my questions and my objections with logical, common sense answers, then I've got to smell a rat. And in most cases, they do have 1 or 2 little bits of, I remember doing something for this guy over here, and this is what this property did. So they have their little weapons of and objection replies, but in reality, if it just doesn't feel right, if your gut's telling you They haven't given me a lot of substance. They've just given me a brush over. They've talked about it and tried to sell me on how little it costs for the household, and house and land packages, and they're really flogging it on depreciation and tax benefits. The reality is there's no scarcity value in that. They're usually in an area that there's going to be an oversupply, and they perform poorly. So it comes back to that asset selection.
Asset selection. So we think that borrowing. We've done many talks about just even a 1% difference in performance over a long time, compounded, makes an enormous difference.
Massive difference.
So the number one way that a property investor will pay is by buying the wrong asset, and unfortunately, that's a rear vision mirror sort of lesson rather than something that you can learn in the moment.
Yeah, and obviously we've spent a long time just talking about point one, but the reason why we've done that is because at the end of the day, that's the wealth. That's the biggest wealth to be made here. You get it wrong, it's hundreds of thousands of dollars over a 10, 20-year period.
Second one is I remember when I first started in property, I saw this picture up on the wall, and it was a really old man. And if you sort of imagine the Mr. Miyagi style beard, the wispy long beard, and it was this really old guy sitting on a bench in a locker room in a looked like a primary school. And it was the caption underneath. It was just an old man in a boy's school uniform, and it said, "This is the young boy waiting for real estate to go down, or the value of real estate to go down." And obviously that struck a chord with me. It was like,
it's a good analogy. It's a good visual, isn't it?
Probably doesn't ever go down. So that brings us to point number two.
Yeah. Look, it does go down, and there is a science in timing your acquisition in the right cycle of the market. There's no doubt about that. But historically, longer term, in big city centres around the world, with reasonable economic conditions and reasonable government security, et cetera, then most likely you're going to see property prices go up because land's scarce. And once that land's utilised and there's a lifestyle element and an emotional element to it, that's what pushes prices higher.
Exactly. So the point being that real estate generally moves in an upward direction. So number two, the biggest way, another way that a property investor will pay is through procrastination. And that could be as simple as, geez, I've been meaning to do this for a couple of months. But it's not uncommon.
It gets better than that.
It's totally not uncommon for investors to come in here and say, if only I'd done this earlier.
Two things.
2 years ago.
Yeah. Well, even better. I mean, if I knew now what I knew in my 30s, that sort of decade look back, or, like I should have bought that property, and everyone's got those stories.
Yeah.
Everyone.
Yeah.
My parents bought their property and it's now worth X, but when they bought it in 1970, I think it was 72 for my folks, they paid $13,000 for it and it's now worth $600,000 or whatever it is. In some cases, there's $13,000 assets that are now worth over $1 million. So that's the big one. And I got an email also from a client who has been listening and watching our videos and listening to podcasts, sent me an email and said, I met you, Ben, in 2007 and I'm just, I'm disillusioned. I've done my investigations and there's all this mixed messages and all that type of stuff. Hasn't done anything. Ooh. So you can imagine.
8 years.
Yeah. Oh, and we had, in some of the forums that we used to run, there was the same people who turned up every time we ran the forums and they were just sitting there waiting, saving these big deposits when they could have got into property so many years earlier. Oh, I'm just waiting for it to slow down. I'm waiting for it to slow down. And in some cases you can get it right. We're not buying in Sydney at the moment because we think it's a bit overdone. But in reality, there's other markets to buy in, and that comes back to being that borderless investor.
Well, that's the perfect analogy, isn't it? You don't have to procrastinate if you're a Sydney resident. You just probably need to exercise caution. Yeah, buy somewhere else.
Exactly.
So number one, buying the wrong asset. Number two is procrastination. Number three, paying too much. And I deal with real estate agents all day, every day, and they've got to be good communicators. They've got to be good at marketing. They've got to be good at reading body language. But gee whiz, they've got to be good at negotiation. And if they're not good negotiators, they're not going to be good at their craft.
Yeah.
And the problem is when someone who doesn't buy real estate often comes up against that, they can fall prey to the very clever tactics and skills that a professional negotiator has. And quite often, if we listen to podcasts on the other side of the fence where we're trying to see who the top real estate agents are, and their goal is to get a premium price, not just a good price, but a premium price for their vendor, so they've got a satisfied client. We're on the other side of that as the buyer. You want to make sure you're not one of the people paying the premium prices.
That's right. So, and I've got a couple of others. their own ego. So even the investor who's turning up to an auction, in his mind he set his price. But when he actually gets into the toing and froing of what is basically street theatre, and then it's an ego thing and there's an audience, they'll run over their price point and they'll basically get to a stage where they're thinking, I reckon they'd have some sort of buyer's remorse. They'd definitely pay too much because they've got into some fight with some emotional buyer and they're thinking, well, that must be what it's worth. And that sort of leads back to lack of patience. So again, it's that I've done this 4 times, I've missed out on the last show, I'm going to buy this one, and they pay a premium for it. So you got to time your activity in a seller's market, and if there's too many emotional buyers, you're in the wrong market. You should have got in 12 months ago, 18 months ago, when it wasn't a seller's market, when it was a buyer's market.
And i.e. buying counter-cyclically. So there you go, folks. There's the top 3 ways. Buying the wrong asset, procrastinating, paying too much for the real estate. And the 4th one, for those of you, I'm a buyer's agent, so this will sound self-serving, but the 4th one is professional advice. And if you're paying for professional advice, chances are you're not going to fall victim to the first 3, because a buyer's agent or a property investment advisor or a qualified property investment advisor, as long as you're getting someone who's capable and competent, will help you make sure you don't buy the wrong asset. They'll actually help you be that sort of little conscious parrot on your shoulder saying, I know it's scary, I know it's a little bit fearful, but you know what? Take the step. You've prepared really well so they can stop them procrastinating. And then, of course, if they've got access to resources of knowing what's previously sold rather than getting seduced by what the listing prices are, they'll help you make sure you don't pay too much. So the number 1 alone, buying the wrong asset, is well worth the professional advice, but helping with the other 2 is enormous.
Yeah, I mean, obviously this is one of my areas of passion, and I was giving property investment advice for many years. And then I thought, well, I've got to get some formal qualification in behind that, because, I mean, if I'm talking to an accountant, they've got an accounting degree. If I'm talking to a financial planner, they've got qualifications. So
your hairdresser's got a qualification.
Yes, your hairdresser. There you go. There's a good example. So the reality is you've got to get that professional advice. And when you do get that professional advice, ask for their qualifications. So what gives them because there's still plenty of people out there who say, well, I've bought 10. Is that not enough experience and that's not enough advice? Well, I've been involved in over... I reckon probably 1,500 transactions. I've given advice on over $600 million worth of property investment. So the reality from that point of view is if, someone's bought 2 or 3 of them and thinks they want to make a career out of this, that's okay. And we encourage that, as part of PIPA, but get some qualifications in behind you. Understand that not everyone is the same as you. You shouldn't be giving your cookie cutting advice to, every person that walks in the door. You've got to basically tailor the advice. And if there's independence, that's the pinnacle, whereby, before you walk in there, I'm not judging you. And we've obviously done some podcasts on that as well. And if this is the first time you're listening to this podcast, I encourage you not to listen to the one last week and then keep working backwards. I actually encourage you to go to the first episode and work through them that way, because you'll get so much more of what we're talking about, because we're taking you on a journey and we're building that wealth knowledge and property knowledge up on that journey. So start from episode 1 and then work your way through. It won't take long to catch up. It's well worth it.
There you go, folks. The 4 ways you will pay as a property investor. It's your choice. Buy the wrong asset, procrastinate, pay too much, or get some professional advice.
So just on the professional advice side, if you are saying, well, who do I talk to? On the PIPA website, which is www.pipa.asn.au.
He remembered.
Yeah, I got that one out. You can actually search for members of the association. Now, PIPA is a non-for-profit association. It has a code of conduct, which is all about making sure that there's full disclosure of fees, and you're dealing with professionals who are qualified to give you the specific advice that you're looking for. So there's just a way so you can search on the website for advisors in your local area, and you can learn more about the companies that are members of the association, which is also great.
That's really good advice, Ben. I've got nothing to do with PIPA other than I'm a member and I'm associated with Ben. But I know that there's been times when people who have been members of PIPA and then shown to lack integrity, ethics, or guidelines, you guys then bump them off the register.
We expel them.
Yeah.
And and don't worry, there's plenty of people who are trying to trade off the PIPA brand. So there's a vetting process to actually becoming a member. Now, of course, those people can put good smoke screens up and so forth, but we're always keeping an eye out for the professional applications of our members and their professional integrity. So if we smell a rat, we'll do formal investigations. We'll suspend them until we can work out whether they've done the right or wrong thing. And we have expelled members in the past.
Very good service that you provide there. So, okay, folks, now I've done a video that's going to go up on the website, thepropertycouch.com.au, on the 4 ways that a property investor will pay. It's a summary. We've talked about it for 20 minutes now, but that one goes for about probably 4 or 5 minutes. So if you're interested in refreshing what we've chatted about, feel free to go and get that, have a look at that video. Ben also puts out monthly his commentary around the Reserve Bank's decision on interest rates, and of course they left them on hold this week.
The opinions are my own.
Well, they're very good opinions, I've got to say. And for those Greek community or people who are thinking about going to Greece, he put a very good commentary around the Greece situation.
Yeah, just wait 6 months. It's going to be really cheap to travel to Greece. Those Greek islands are going to be busy.
They are. Well, they're going to be busy in Greece this weekend because they've, of course, got a bit of a referendum. And we've got a favour to ask our listeners, because a lot of the feedback that we've been getting is that people have been really appreciative of the free information and the quality information that we're giving. So we thank people for that feedback. But we've got a favour, and that's if all of our listeners could please go to our website, thepropertycouch.com.au, and vote for us in the Investor Choice Awards in the Education and Mentoring division for the Property Couch, because that would be really helpful for us to actually get our message out there. Because each week we come together, we have a chinwag about some topics that we've sort of applied during the week, and hopefully there's some huge benefit for the listeners. But unless we get, you always say you can't sell a secret.
No, you can't. And it's about protecting consumers. So for me, this podcast is about educating and protecting consumers. It's a high value transaction. So if people think there's value in what we're doing, if you could be kind enough to vote for us, we might become a finalist, and that obviously gets the message out there for everyone, which is great.
That would be great. So, folks, we are asking a favour. If you do get a chance, we know people's lives are busy, but if you could go to thepropertycouch.com.au after you've listened to this one and vote for us in the education and mentoring section, there'll be links on the website. That would be very, very much appreciated. So there you have it, folks. You've now armed with the 4 ways that a property investor will pay. So you can hopefully apply that to the decisions that you may be looking to make in the next upcoming weeks with your property portfolio. So, Ben, time's up. We've got to move on and get ready for next week. But any parting words besides our sort of... Have you got a Greek sign-off?
No. What's the Greek sign-off?
We should have researched that in advance. But so, all right, there you go, folks. That's your insider's guide to property investing, the 4 ways that a property investor will pay. So until next week, we will see you. What is it? Sayonara.
Sayonara.
Okay. See you, folks.